Oh, we're definitely on it. When Robert presses the green light and we come out of the green room, it zooms in and focuses on us. So it looks like we're there. Hi, everyone.
Hi, everyone. Thanks for joining us.
Hope everyone's
doing well.
Yep. Good morning, Robert Pease.
Good morning, Julie Harrelson. Pleasure as always to see you and talk to you. We haven't seen each other in person in quite some time, but we do spend a lot of time together.
I was thinking this morning, it was early March. So March, April, May, June, July, it's been, almost 5 months. So, but it's great that we have this technology so we can keep things moving and connect with all of you that are online. So yeah. This is really an hour for the folks that have registered to ask us any questions that you might have. Robert and I, in fact, we were talking right before we started, and we realized that it was 9:01 because Robert and I never have any lack of things to talk about. So if you don't have any questions, there's certainly things that we can cover that we've been seeing in terms of trends. But our lines are open for questions, and we'll give you a minute. Okay, there's one.
Yeah, that's a good one. We'll get to that in a second. Good question, Jim. So just logistically, we got a chat box over here. We certainly will pay attention to. The easier thing is there's down at the bottom here somewhere, there's a thing that says ask a question. So
you can vote for the questions too to prioritize them if they are questions that you think should definitely be answered.
Yes, kind of gives us a punch list of stuff to work through. So yeah, so that's the whole purpose of this. We did several of what we called Ask Us Anything sessions. We all sort of surfed into phase, I guess, 1 or early stage kind of shelter in place and had good dialogue, good conversations. And so just wanted to sort of open ourselves up to answer your questions. So if Julie, if you want to take that first question about the 458 pages of legal documents, that would be helpful.
We feel your pain on the legal document question. We deal with the same thing because we have substantial legal documents for investment. And, we can't give you legal advice, but I would say from a business perspective, there is really nothing better than having a great attorney on your team. There has been a move in the last number of years to standardize on documents. So NVCA, the National Venture Capital Association, has standard documents. But, for a lot of founders, this is the first time you've encountered all of these things. So bylaws and governance documents, note documents, those kinds of things. So a couple of things. One is to find an attorney that actually has experience with doing transactions. So there are a lot of standard business attorneys that will say, oh yeah, I'll help you. But if they haven't seen a number of deals, it kind of limits their perspective. And so having somebody that's seen a broad array of deals that's available to you, that doesn't charge you an arm and a leg. And there are a lot of firms that actually do special packages for startups to get you launched in the hopes that you'll turn into a great long-term client. So I'll start with those points. And Robert, you want to elaborate?
No, I would echo all those. And Jim, there's a lot of, as you know, right, really good folks in Portland. If you've got a question on that, follow up afterwards with an email, and I can, it won't be necessarily an endorsement, but it's folks that we either work with or have worked with on the other side of the table. But I think Julie's point is right on. I mean, there's this standardization. So if you have these National Venture Capital Association documents, and those are for equity sales, right? So there's complexity when you sell equity in a business, especially a private share offering, right? So there's just, whether you're Ford Motor Company or your new co, right? There's the same set of issues. It's just about the emphasis on different pieces. And again, back to like, if you're doing a transaction and both sides agree that the template essentially is the standard, and then you can lawyer from that. This is also where things like convertible notes and plus or minus more recently SAFE documents, which is a simple agreement, right, for future equity. And there's good and bad on all of those. A convertible note is essentially a debt instrument, but nobody wants the interest payments. You want it to convert to equity. It's an easier thing, costs significantly less. And the SAFE that started out of Y Combinator was designed to attack this very problem, right? Which is like, look, let's just get some money in, to kind of get the company to its next milestone. So I think that, you can't get away from the complexity of a stock purchase agreement. It's going to have what it needs to have in it. And like a lot of things in contracts, most of it is about what happens when things don't work out. Although there's obviously stuff that needs to be in place when it does work out. So good question.
Yeah.
A long rambling answer there, sorry.
A couple of other points on this. I think the reason that we have long answers on this is because it's a complex question and there's a lot to it. But one of the things you'll find about safe notes is a lot of times investors will balk at those. And part of the reason is that there are in some safe notes, there are a lack of certain kinds of provisions that provide a little bit more detail and a little bit more protection for the investors. And so it's a simpler instrument, and it can be done. We've invested on a number of safe notes, but there are going to be some things that we as investors want to have included on that. And I think entrepreneurs hate often hate the burden of this and think, oh, attorneys are there, just the clock is ticking, but really these agreements can mitigate so much trouble down the line because you've gone through it at the beginning and you've made these agreements. And as long as you understand them as a business person, you're going to have a lot less trouble down the line because you've actually been clear up front about what the spirit and the rules and the legal parts of your agreement with those companies are. So you want to move on to the Africa question?
Yeah, that's great. We're worldwide, which is awesome. Thank you for whoever is either joining us from Africa or has an interest in it. The question is, I think, do we invest in Africa? The short answer is no. We, in terms of our sort of investment focus and criteria that we look for, we kind of have a couple different levels. The first and foremost lens or filter on this is geographic. And so we are focused on the Pacific Northwest in the United States with an Oregon first mindset, meaning that we're based here in Oregon. We certainly have an interest in the entrepreneurial ecosystem here, but we have done some investing in Seattle. We look broadly. We looked at places like Boise. We looked at places like Spokane, Washington, Missoula, Montana, places like that. We've looked at a few things in Salt Lake. We normally don't wander too far into California. But if we do wander further afield, it generally has some tie back to the region. It could be a company located elsewhere that has a key executive, in Portland or something like that. We've done a couple investments like that. So that's my answer to the Africa question.
Yeah, and I think if I'm remembering correctly from the registration that you're in Accra, Ghana, and I wish that our reach was that far, but I wish you really well in your entrepreneurial journey.
Yeah, no doubt. Thank you so much for joining us. That's awesome. Hopefully we deliver something valuable to you in this conversation.
And are we actively investing? Yes, we just closed an investment about 5 minutes ago. Well, 15 minutes ago now. So want to talk about what we've done this year and kind of our cadence, Robert, and where we're headed the back half of the year?
Yeah, for sure. So we out of the current fund that we have, we started investing in that and kind of out of that in kind of late through Q3, early Q4 of last year, and have continued that pace. Some of the investments that we have closed during the sort of COVID time were already in pipeline, but there's been at least two that we have all done this way. We haven't met the entrepreneur in person, and so we're not necessarily trying to write as many possible checks as we can. I think there's a thoughtfulness here around the investments we're making, the macro environment. There have been some new opportunities or clarity on opportunities created. I think digital transformation as a core investment theme really is accelerating here. That's maybe one positive out of a very negative situation. So we're continuing to do that. We've got a lot of companies in process that we've had conversations with. So if you're on this and you're sort of in process with us, this wouldn't be relevant to you. But we're going to do an open application period. It's something we try to do on standard intervals. We're going to launch that on, I think September 14th was the date we decided. I think that's Monday, September 14th. And that's literally pretty easy, right? It's like it's a Gust interface. You upload your stuff. We'll take a look at that stuff. So you don't have to know me or Julie or someone that knows us. You don't have to get a warm referral. You don't have to know the secret sign. We're interested in talking to entrepreneurs about that. So yeah, we have a very active investment posture, and we'll continue that with this fund through this year and into next and even the following. So we've got quite a bit of capital to deploy.
I wouldn't say that, and I don't think that we've slowed down, but in terms of help that we're offering and things that we're looking at, and we always do this, but it certainly has risen to a real point of focus. Is the company have enough cash to ride this out for a while? So you don't want to invest and then have somebody run out of money in 3 months or 6 months.
Yeah, we have gotten a little more sensitive around that, which is that our target check size out of the current fund is $250,000, and so if we're investing in a company and we look at sort of the burn rate and we look at the runway, we may want a minimum close amount on that round higher than that. We've done that a little bit, right? Which is like, okay, so we can commit 250, but you need to raise 500 just to sort of give you the runway that you need to. So it's a little bit of friction in the deal, but it's not because we're being mean. It's literally around. I still think where we are, we've kind of, I guess, survived Q2 to a degree, and Q3 and Q4 this year are kind of about sustaining. And we haven't necessarily gotten out ahead of COVID, and so that implication rolling into Q1, Q2 of next year. Originally, I think when we were noodling on this, it was like, look, we probably will have some return to a growth mindset early next year. I don't know if that's the case, right? Q1 may be a sustained quarter as well. So just in terms of your own planning, forget about fundraising and just I think in terms of your cash management is to think about that, and approaching an investor and having a very cash forward mindset, I think is A, always important, and B, I think at this point in time, even more so, just so you don't sort of hem yourself in to say, look, I'm going to raise a little bit of money and then I got to get back out and do it again in November. Like, I think that's a tough place to be.
Yeah. Let's see what else. So what stage should a company be in when they engage with you? And that's from Lloyd. So Lloyd, when you, if you go on our website, there's a link to our Gus profile, and it has detailed criteria. But essentially, we're often the first institutional money into an investment. So what happens is it would be very unusual for us to invest in a pre-revenue company. I don't think we've done one. I mean, some have had a very small amount of revenue, but you need to have revenue and a team. And this is, something that Robert likes to say. It really boils it down. It's like, have you built it, and do people care enough to use it, and do they care enough to pay for it? So if you've ticked those 3 boxes, then that's something that we'd be interested in looking at. And if not, then it's not really something that would be in our wheelhouse. There's another related question about pre-seed funding, which we can get into, but let's talk about a little bit more about our stage. Robert, you want to add some color to that?
Yeah, no, I think those are the points to hit. So when you engage with us, that's the lens we're looking at. 3 questions, right? Have you built the thing you think you can build? Right. In other words, it's beyond aspiration and spec. Does anybody care? Which means beyond your friends and your family and your sort of self-reinforcing social graph. Is it like in the hands of your target customer or your perceived target customer? Whether or not they've paid or not, they're using it. I think you can learn a lot from that. And then the third box is, does anybody care enough to pay? And it's not meant, again, to be sort of torture. That's for you. Because if you take your company through those 3 steps, you've increased the value of your business significantly. And you're able to command a much higher price from an investor, which means you sell less of your company, which means you own more of it, which is, from an entrepreneur standpoint, you're trying not to sell every part of your company to get it off the ground. The notion of pay is one. I think it's important. A long time ago, an entrepreneur that I worked with talked about, you can have lots of great ideas, right? But you got to visualize someone taking $1 out of their pocket and handing it to you for your thing. You're delivering enough value. It's compelling. It's clear. So direct revenue businesses are pretty clear, right? It's like, hey, I knock on the door, I show you my thing, and you want to buy it, and I invoice you. More businesses have a little more complexity related to transaction volume. maybe related to kind of ad spend, so stuff that's dependent upon some level of activity. That if you're going to base your business on that, it's super important to begin to sort of go into that to unpack if that's possible or not. So those are just areas that we're going to poke and prod, right, in terms of what we look at. So I think that's the thing. I think the other thing that we'll look at from one's geography, and then we've got kind of our 3 questions. The other is sort of emphasis area. So we invest in software and technology. It's a good percentage of the portfolio, but we also invest in consumer products companies with a particular emphasis on direct-to-consumer brands. So we're interested in brands and brand platforms. Not necessarily like a single SKU business, right? If I have one thing, we always are going to say, that's great, you're building on that, you've got good revenue and good traction, but what, in the future state, like, can that brand expand beyond so you have a little more of momentum? And then, or do you have a direct relationship with your customers so that you're not dependent solely upon the wholesale channel or Amazon? You can have that in the mix, but we'd like the emphasis on the direct relationship.
So why don't you kind of scaffold into the pre-seed question? So if a company is pre-seed and they have rising demand during the pandemic and they need some financial resources and some investment, thoughts on that?
So by pre-seed, I'm just going to read the question here. Rising demand. Are there funds or angels looking to invest at this time? If you've got demand, and I don't know, maybe you can follow up in the chat box, whatever it is. I mean, have people paid for this? Maybe it would be my question, right? Because sometimes there's a line between, hey, I'm pre-seed, which means I have, I can't do anything unless I raise money, right? And that's going to be back to the capital requirements of the business, versus having a little bit of money would make this easier. And again, it's not so much to try to torture you as much as it is if you've got this signal, which is you've built something, there's interest, right? The next layer of signal for your own benefit is, can you monetize that? Will people actually pay for that? And then that may recalibrate how much money you think you need. I mean, customers are a source of capital. It's a non-dilutive source, so it's good for you as the entrepreneur. And then it puts you in a little bit stronger position, so you can stop talking about being pre-seed, right? And you're actually like, hey, I've got a going concern here, and I'm just trying to raise some expansion capital. I don't, there's not a ton, our investment thesis on our fund is not concept stage. You will find investors that have a little more interest in early stage stuff. I think there's stories that float around about, hey, I met so-and-so, I talked to them for 10 minutes and they wrote me a $50,000 check. I wouldn't get too hung up on those. I think that can happen. I think individuals have a little bit more leeway to write checks fast. As a fund, we are responsible for other people's money. And so as a result of that, we have a process. We think it's pretty efficient, but we have a diligence process, and we have, a way that we go through, and there's certain things that we're going to want in place. As Julie said, a lot of times we're the first institutional money in. So things like assignment of intellectual property is a big deal for us. So we want to make sure that's papered correctly. And take this all the way back to good lawyers, right? The most expensive lawyer is an inexpensive lawyer. It all sort of papered out of the gate. If you're going to raise external capital, especially from institutional funds, even if it's a small fund like us, we're still going to want the same kind of things. So I don't know. That's a random wandering answer for your question. Like, I don't have here's how to go get pre-seed funding answer. Right. I think you got to hustle a little bit more around that. And I think you're going to find more individuals that would be interested in that path versus funds.
Yeah, I agree with that. It's often a subject matter expert, somebody who's an angel investor that likes the domain that you're working in, that has some form of knowledge.
Yeah. And
it involves a lot of conversations usually, and a lot of no's. And it is also the most expensive money because you're early, you haven't really de-risked whatever the product or the service is. And so it can be a real push to get money. There are options where certain kinds of advisors will also buy into company. And we just always want to make sure to share with entrepreneurs our perspective that just doing as much due diligence on the potential investors as we do on you is really important, because they become a business partner over time, right?
Yeah, for sure. I absolutely agree with that. And then, the other sort of, I guess, exit point on this is kind of broadly thinking, like your operating plan drives your capital needs, right? So a lot of times when people start companies, your social networks are like, oh, going to raise money. Well, how much do you need and when, right? And so where you are now to achieve your next milestone, how much do you need, right? The overall capital requirements of the business over 3 years may be $5 million, right? But for the first 9 months, it may be 100,000. So then focus in on that and focus in on the type of investor that would be interested in that to hit the milestones you need to get to the next round. I mean, I know in a perfect world, you'd be able to get all that money, out of the gate, but then you're going to sell a ton of your company because you haven't built much value, right? I think that's kind of the tension. And then the other side of this, when you do take external capital, what you're taking on is you're taking on an expectation that you will be able to compress time and growth, right? So you have your plan. It's on your sort of schedule. You're driven. You're doing what you need to do. When you take money from an external investor, they're not only putting the money in, there's an expectation of that money coming out. That money coming out 6 to 8 years, and the multiple on that revenue, or excuse me, the multiple on that investment being high. So the pressure that you're going to begin to feel as an entrepreneur is you got to grow faster and you got to do it in a shorter amount of time. So that's a question to ask. That's the open question for any type of venture funding or external capital that you're going to bring in. Funds are going to have a certain threshold. Big funds are going to have a certain threshold. Individuals are going to have a certain threshold. So I think it's important to sort of discuss that in the context of the fundraising and not just get the money in the bank, as Julie said, right? This is a long-term contractual relationship, which is very difficult to get out of, and can be a distraction if it doesn't stay positive through the life of the business.
So there's a question about the impact of the pandemic in Oregon specifically. And I think, so of course, everything we're saying is personal opinion based on our experience. But I think that if right now, there's been an uptick in numbers in Oregon, and so if that gets out of hand, then I think it's going to have a huge impact. And of course, I'm not going to get up on my soapbox, but we all can we can all impact that based on wearing masks and social distancing and washing our hands and staying home as much as possible, which could potentially have a slowing effect on the number of new startups. But I think if we can continue the mitigation strategies that are being recommended, then the economy won't shut down again. And that, I think, if we have to be shut down again, it's going to have a huge impact, both from a slowing effect, but also from a morale effect. And I think anytime you get those two things together, it just simply slows things down. If it can continue to be managed and the numbers can continue to go down, then people's optimism will stay up and the economy will stay open, and then it's going to be a little bit smoother sailing. But I think that as we get into the back half of the year, we're really going to see where that goes. I think in the next 90 days, we'll show it. Will give us a lot more information. And the good news is, many successful companies are started when things are really, really tough, and that's the space that we're all living in. So we have an optimism I think we share an optimism about that. But I think it really remains to be seen what happens in this back half of the year. Robert?
I think that's extremely well said. My disclaimer, as always, or our disclaimer, is that we're opinion based here. But as you were kind of going through that, this has been a very weird time, and there's a lot of suffering that's going on. There's a lot of unrest and angst, and it's sort of this confluence of so many things. But what it's not like is 2001. What it's not like is 2008. So the federal government certainly has no shortage of things it probably could do and has been able, should have done better, but the amount of liquidity that has been injected into the economy, right, and the backstop, and as much of it was a bit of a confusing time, but these paycheck protection loans, like that was a tremendous amount of capital that was all designed for us not to sort of go over an economic cliff immediately. As this sustains, and then you see this debate that's going on now, right, about another phase of the stimulus. I mean, the downside of continuing to write $1 trillion checks is kind of large as well. But I think that economically, right, we've avoided a lot of things, and in our portfolio, even dating back to the first companies, right, companies that were struggled more, right. I think it accelerated maybe something that was maybe not going to work for them anyway. But there's been a lot of companies that have accelerated out of this. And so, and even just sort of, spot checking as we talk to different people and you talk to lawyers, how's business? Well, we thought we were going to be down, 40 to 30 to 40%. We're actually tracking at plan or just below. Interesting, right? So there's so much of the economy that's clipping along here, in terms of processes that are, either improving or sustaining. We meet like this now. You could argue that that's more efficient, but it also takes money out of the pockets of the airlines because we're not flying to go see each other. So there's these ripple effects, right? How that impacts Oregon specifically versus the region versus the United States versus the globe. Just much smarter people than me.
Yeah, and I'll tell you what. Something I read that Robert and I are all reading stuff all the time. Just trying to track things. Somebody said, if somebody tells you that they know what's going to happen, they're wrong or they're making it up or something like that, right? And so this is a time to be super nimble, super flexible, work on your own resilience as a leader, because this is a very stressful time because, in some ways there's always this level of unknowns, but it's really emphasized right now. And so just making sure also that you're doing what you can to keep your own strength and clarity, mentally, emotionally, and physically, I think is really important. And we don't talk a lot about that aspect of leading businesses in these types of questions, but I think it's a really important feature of this particular time. So what else do we have?
I just want to say I want to give a little brag on our audience here. Great questions. Thank you for the time, and thank you for the questions, and hopefully our voiceover is delivering some value. There's one, and I'm just sort of looking at them, not going in order, so shame on me. Lloyd, this is from you. Notice that successful companies started when things are tough, as well as people do say that. Why do you think that happens? Yeah, it's a little bit of a cliche, right? When there's economic pain and, that's when the best companies are built. I think if you unpack that a layer, I think that a lot of it is around availability and attention span of really talented people, right? The most talented people are always working on something. And if something happens and there's a disruption and they can't work on that anymore, right? Outside of their control, right? They got laid off or their company went out of business. And you saw this again in these cataclysmic times, right? Of 2001 and the .com era. It just sort of stopped, right? And really, really, really good people weren't working anymore, right? Or the 2008 financial crisis, and you had, not only the financial sector, but you had a lot of other industries that got really disrupted. And so there was this, smart people looking to do stuff moment in time. I think that's part of it. I think also people get a little more focused on what really matters. I mean, I realize having 9 flavors of gourmet snack bars in the company cafeteria is an important amenity, right? But it is really, really not related.
Ping pong table.
Yeah, look, I mean, I think those things are important, but when there's 2% unemployment and you're competing on amenities, I think that's a very different game than when there's unfortunately 8, 10, 12, 14, 15% unemployment. When you can actually really burrow in on skills and you can go and get really talented people and reward them through rewarding work, right? Your best people are really going to, they're going to be rewarded based on that more than they are on, whether or not you got a Slurpee machine in the. Well,
you're making me think, sorry to talk over you, but a couple things. One is, Harvard Business Review did this article a number of years ago, and it said, what is it that actually incents people? And is it pay? Is it amenities? Is it, this, that? And it turns out that it's progress. And so when times get tough, I think human beings want to work towards progress. And the other thing that came to mind was, and this is a little bit out of context, but I often think of things in terms of metaphors. So when I was living in the Portland area, and I was living between a lake and a river, and there was a flood, and the lake could not accommodate the amount of water, so the water was flowing over the highway, and the river was full. And so it was like, what are we going to do? The whole neighborhood's going to flood. So there were professionals involved in this, but all of the neighbors got together and created a channel between the lake and the river so that the water from the lake could overflow into the river. And it was by necessity, right? So it was like innovation. We turned our parking lot of the condo where I was living into a river, basically, to route the water overflow into the river. And it's like that's where necessity is the mother of invention comes from. So a lot of innovation happens when there's constraint, because you've got to solve problems, right? You've got to like knuckle down, manage your cash, figure out a problem, and go after it. And you're right, Robert. I think too that people pay more attention to what matters. So if somebody's been thinking about something that they wanted to do for a long time, and they get furloughed, it's kind of like, well, often it's just like, I'm just going to try it. I'm just going to, give it a go and see if I can make it happen.
Yeah, no, I guess we could. I think again, there's a lot to unpack in that question, because I agree it's a cliche, especially if you're on the receiving end of losing your job when all you were doing was what you were supposed to do, right? I think that's sometimes a tough place to be. But the other piece of this that you'll find in slower economic times, maybe as we evolve as a working world, not as big a deal, but you can get better deals on leases. You can get better deals on contracts. You can get better deals from service providers. You can get better payment terms. Like all of that begins to factor in, and so you get this. A down economy gives you these sort of advantages from starting from scratch, and relative to larger companies who may just be sort of getting into a defensive position versus an innovative position, right? Is it that it may actually open up some opportunities where they're not going to be as inclined to want to get into. Yeah, good question.
So any of these things that we're saying, if there's things that you want us to elaborate on, feel free to comment in the chat or add more to your question.
Or if you disagree, just light us up. You can use all caps over there, and you can kind of tell us that we don't know.
So this question about how do you feel about collaborating with other investors, and the answer to that is almost every investment we're involved in, we're collaborating with other investors, because most often the companies that we're working with are raising more than $250,000, and we don't have to be in the lead position to make an investment. So most of the companies that we work with are raising somewhere between $500,000 and $2 million. Again, it may be the first money that they have raised, and we've collaborated with individual angels as well as many other funds, both locally, in Oregon, across the Pacific Northwest, and from across the country. We also have, as a result of our companies growing, because we have quite a number of companies that we're working with, we have a network of funders that are Series A funders that we often put our companies in touch with when they're raising their Series A round, which is the next round after seed.
Yeah, so just a point to build on that. So co-investors is something when we look at an investment opportunity, we actually spend time on, and we look at and we kind of articulate. And I think that's both positive as well as negative, right? So sometimes, really positive signal can come out if someone that's in the domain that has a lot of experience has written a check right into your company. So an individual investor that says, yes, I'm validating this from both my reputational standpoint as well as my, my money. I think that's important. But I also think that if it's strange is maybe the wrong word. If it's a if it's a unique funding setup, and that can go a lot of different directions, then that can lead to some negative, because what, again, our stage that we're investing at, we're at the sort of seed or seed plus stage, to parse it. Sometimes we do opportunistic Series A. We are not a control oriented investor. When you work with us, we are interested in assisting and helping and accelerating you either to the next round of funding or to your plane of profitability. We are not asking for board seats. We don't think it's important, or we think it's important not to totally muck up an early stage company's board at the seed stage, because all of a sudden you get 4 or 5 people on your board of directors, and then you go out and you try to raise an institutional A or B, and that becomes a thing that has to be dealt with. So that can create friction in a deal. So I think those are, as we look to kind of help, if you will, or invest at the stage that we do, those are sort of things that we kind of keep kind of forefront. And I guess this is a little bit of a goblet of an answer, but depending on the co-investor, right? They could either have the same outlook or they could have a different outlook, right? They could have an outlook back to the expectations. I think, life's relationships, both personal and professional, are defined based on shared expectations. Back to compressing time and growth. If someone believes that you're going to go 1,000x next year and you don't, and they're going to get grumpy about that, and that's an investor, and that investor has 1, 2 board seats, right? That makes your life really difficult. And so co-investors matter in that regard, right? And making sure that you've got the right investor to the right business at the right stage.
Yeah, that's really well said, Robert. What else do we have? Oh, this thing about remote work. So, I just found the Slack from you can be here at any time. So, go.
No, I was going to say, right. So I'm all for it if you like to have 5 different variants of whatever gourmet snack bar.
But Siemens yesterday just did, made their workforce primarily virtual, like giving people most days they can work remotely. And I would say I'm a fan of remote work, and I always have been. I have only had a job like 2 years of my entire career where I had to go into an office every day. So we work remotely, and we've actually been doing that pretty much since the beginning of having an expanded team beyond myself as a founder. And I think it's great. I think there is something about people, being together in person that can't necessarily be replaced. But I do think that this works really, really well. And my guess is, I haven't studied this, but from a anecdotal standpoint, what I've been hearing is that people are much more productive working remotely. And I think it, in some ways, it creates an opportunity for there to be more, not necessarily work-life balance, but work-life integration, so that there's a little bit more humanity in work, and there's a little bit more productivity as well.
Yeah, no, I agree with all that. I think that you'll find, I guess from an investor standpoint, you'll find investors that have a mindset that says you can only build a successful company if you're in the Bay Area, if you're in Boston, if you're in Austin, Texas, if you're in Atlanta, if you're in Seattle, right? You got to be in one of these hubs. And then you'll find others that are like, great companies can be built anywhere. And I think we're in the latter spot, right? So it's why we invest the way we do. We believe great companies can be built anywhere. I think that you then have to filter that a little bit and say, look, if you want to build a semiconductor company, right, that may be hard to do remote. You want to build a software company? Probably do that. And I think that as a CEO, right, or as the founding team, you have to set the cadence around this, which is, what is the blend between production, which folks can certainly be more productive, when they're not, all stuck in an office together, versus collaboration, or versus when physical gathering needs to happen. And you'll see all sorts of different, evolutions of this. I mean, WordPress, out of the gate has been a remote company, but the teams still gather, right? It's not that everything is electronic all the time. So I think that's part of it. Ages ago, one of the startups I was in, we had a work from home Thursday, right? The other days we're in the office. And so it's a heavy engineering software development team, and we were able to sort of monitor, code commits, essentially, right? And we found on Thursdays that was the most productive day of software development. because we had a pattern where people would start work early, right? 6 to 8 or whatever it is a.m. And then there was a little bit of this is an older workforce that had kids, a little bit of a lull. You take your kids to school, right? Back to kind of work-life harmony. And then a surge of activity after that, right? To literally through lunch to like the end of the school day. And then a drop off that would kind of drop off through dinner time, early dinner, and then another surge, right? That would happen sort of, 8 to 10, 8 to 12, something like that. So get your head around something, you're working on a problem, right? You've got your schedule, you're able to do it. So in that case, from what we were building and how we were building it, that actually was a productive day. But then the next day, everybody was back together again, right? So that was a model, right? And you may see some of that come together. But like, again, great people are located anywhere, right? If you're building a company and you happen to be based in Bend, Oregon, and you find someone who is a great front end designer and they happen to be in Albany, New York, like you should hire that person. Like I don't see that as a downside as long as you can manage the workload, the performance, right, the objectives, all those things. So it's more about you as the manager, right, than it is the employee that you're bringing in.
So this is really interesting. These questions are great, just so great. What creative funding approaches that are successful have you seen come out of this COVID period, ones that are perhaps unique or a logical evolution of ones that existed that have accelerated? So I'm not sure accelerated, but what we've seen people, some really interesting things being done with crowdfunding with certain companies where they were testing, kind of doing market testing to see if there was really an interest by doing a crowdfunding program because they could not get more traditional investment. They expected a certain outcome, and I think they had like triple the outcome. I'm trying to think of other things that we've.
Yeah. I think that I think there's a bunch going on in here, right? And again, we have our this is our lens, our fund, and our process and our approach has always been pretty kind of dialed in as it relates to, we think, as it relates to being open and accessible and trying to be transparent and where you stand and what's going on. But the industry as a whole doesn't have a good reputation for that, right? It's hard to get the no. Sometimes it's harder to get the no than it is to get the yes. So you just sort of get drug along. And I think what's happened during this time, because now there's so much more of this, right? And then a lot of these, like a demo day or a program that you may be part of, which maybe was constrained physically to the people in attendance, and the people in attendance had to pay a bunch of money to come. You're seeing much more open. I mean, I'm not sure the model's quite there yet, but these notions of virtual demo days that open up to basically anybody on the planet. So I think as an entrepreneur, as a startup, you have a much larger stage that you can perform on now, and an acceptance of that's the way to learn about you, right? So, Plug and Play, which is an incubator, did a big week-long thing of all the different sort of domain specifics they do. Techstars did theirs. I mean, even Portland Incubator experiment, Pi, right? Went virtual, right? So I think that rather than sort of saying, oh, I have to work that into my calendar and I got to be physically in the location and I got to do what I need to do, it's there's a much easier sort of there's a bigger stage to perform on. I mean, still you have to sort of engage and you got to get on rails and you got to get into process and all those things. So I think that's part of it. And to Julie's point as well, crowdfunding is make sure you got good counsel. Again, back to the most expensive lawyer is an inexpensive lawyer. As you do this, but Seed Invest and WeFund are some of those things, especially if your product is focused on the type of people that may be participating in those, you get the double whammy, right? Where you get a little bit of customer acquisition along with a little capital. Circle, which is one that focuses in on consumer products. So it's a way to kind of almost think about customer acquisition as much as it is funding.
But it can be very complex. And, so again, this isn't something that we're promoting. It's just something that we've seen happen. We've also seen a lot more kind of, I'm going to say more nuanced or more detailed. Robert, maybe you can help me with this, but in terms of phasing and what the company is doing and what the priorities are and how hiring has happened, we're seeing people be much more thoughtful about how, there's only a finite number of knobs and dials that you can turn. It's like you've got a soundboard and you're trying to be successful over a period of time. And we've seen people be much more focused and thoughtful about the key decisions that they're making. Like when there's a lot of money around, people feel like they're smarter than they are, and they sort of, I want to use the word run and gun, but it's too violent. But sort of like, okay, we're doing this and this and this, and this is a much more, okay, this is where we are. Here are the key decisions we have to make. How should we prioritize? Kind of sensibility around managing the businesses. Can you help clarify that? Or are you reading a question?
I'm looking at questions, and so it's not that I wasn't listening, Julie. It's that maybe I wasn't listening.
Multitasking at its best, right?
Yeah, for sure. Hey, so I was just reading a question here. This is back to the kind of the pre-seed question. We've got customers. Yeah, I mean, we could. What I would recommend here is, and again, I think through this we've got an email address. If not, pop it to me, Robert at CascadeSeedFund.com after this. And so again, we're calibrating to open an application period on September 14th. And again, that's not designed to be an obstacle or a hurdle. It literally is designed so that we can do the work that we want to do and give you, the transparency back, right? So in other words, the clock starts on us when we have that, and we've got workflow that will descend from that. So that would probably be my there. So just send me an email. We'll get you on that mailing list. We'll send a big email blast out when we do that.
And for us,
that's
really about accessibility. So the VC world, the funding world is a little, and Robert mentioned this a bit earlier, that it's about, you got to know a guy who knows a guy who knows a guy. And we do get some direct referrals for potential deals, but we continue to do these open application periods because we want everybody who thinks that they fit the criteria to have the opportunity to apply. And if you fit the criteria and you apply, you will get a conversation with us. If you don't, and the main area of fudging in terms of not meeting the criteria is the revenue piece. So, but if you, again, this is kind of our, in a way, our give back and our ability to really understand what's going on in the ecosystem and in the environment with the very early stage companies, because we want to engage those conversations early and we want to be accessible to you.
Yeah, for sure. So we've tried here, and again, we tried on the website, on the Gus page as well, like list criteria. I mean, that literally is the filter. And if you're going to misrepresent where you are, we've had this before, right? And we unpack that in the course of a conversation, like that doesn't benefit you, right? Because now we've wasted everybody's time. Again, we try to be super clear around it. So, I mean, basics, right, is like, be clear and accurate with where you are and when you are. And sometimes it's okay if you're like, look, I don't have all these things set. I'm planning on raising money, now to hit these milestones, and maybe it's time for us to talk in Q1. That's okay. Start building sort of relationships early on. I think that's fine. I had another point in my head that's now just completely left. Okay. So.
Yeah, so if you are interested and you have a company, there's Jim McCrate always sends in some great questions, and one of them is, does the business plan ever survive the first contact with the company? And I think we like it when companies have a clear plan about where they are, what milestones they're going to hit, who they are, and what their early sense of an exit strategy is, and some way of telling us meaningfully how you will get there. But we also know, I mean, we're multi-time operators. We know that those things change. A PowerPoint is not a stone tablet. A piece of paper with a plan on it is not. It is, we know that those things are going to adjust. So there's a lot of factors that we look at, but that's the starting point. And the customer is going to give you a lot of information that's going to help you develop your company more quickly.
Yeah, I think that like going through the effort to write a well-written business plan, for our needs, that we don't want that, right? We're gonna start with our sort of currency is a pitch deck, which is a distillation of that thinking. So I think that as an entrepreneur, you think about your plan, you have to think through all the details to sort of distill it to the summary level. So I think that's one level. So don't think that you need to come up with a binder and it's, look, I got 80 pages. And but the other part of that is, I think within that you need to know your sort of core bets, right? Or the things that you're making assumptions around, and you isolate those. Like the whole premise of me doing this is that these 5 things have to happen. Here's 5 macro things that say I'm right? Here's 5 macro things that say I could be wrong. And here's what I'm assuming is correct. And then you attack those assumptions to validate or prove wrong. And that's the iterative process you go through. Like there's no shame in being like, hey, we started this, we thought it was applicable to telehealth, but we actually ended up getting into, whatever, right? That's okay. That says that you've kind of got this iterative mindset, kind of going forward. So I think that that's it. And again, what we like to do when we sort of start working with a company, this is kind of just back to sort of trying to build the investment case, right? So a business is a business if you can sell it for more than it costs you to make it, right? You got customers that keep paying you, bang, you got profits, business. What we're looking at is the investment case on the business. So it's never a question of the business. It's more back to compressing time and growth, right? Is there a point in time we can put money into this thing, it'll accelerate, and we can get to a scenario that says we get more out of it? Those are the things that we look at. And so part of that is, which I like to think about, is like, what's $1 million in revenue look like for your company, right? And I think that's part of the plan, which is like, okay, if you're saying you're going to charge $6.99 per year for something, how many customers do you need for $1 million in revenue, right? And then do you have to earn that revenue every year, or is that a recurring? I mean, all those things begin, and that's just helpful to you as well. If all of a sudden you're like, I'm going to have 78,000 customers, that's a lot, right? Or it's not, because it's ready-made and you got a bunch of data that says, look, and we're not even trying, right? I mean, we had an investment we made a couple of years ago where they had built a bunch of traction and they had really good momentum and they hadn't spent any money on marketing. And they're like, we don't have a bunch of money, but we experimented and we spent a couple $1,000 on a marketing campaign and it yielded $15,000 in revenue within like 2 weeks. So that's a good signal, right? Kind of related to the upside potential.
Maybe we should talk a little bit about that. Just some people on the phone will be aware of this, but so where we tend to invest is at the seed stage. $250K per investment is our guideline. The companies are usually sub $8 million in valuation. And we're a small fund, so we don't have to seek out unicorns that have, I was going to say, bazillion-dollar exits. We can, a company can grow to a certain size and create value for our investors. So, and we think that that's appropriate for this market in Oregon and the Pacific Northwest, to seek companies that are, it's more of a base hit strategy than it is a swing for the fences strategy, if you will, from the sports analogy standpoint. And, I think that's an important thing for people to know, kind of where we sit in the capital stack. Robert, do you want to elaborate on that?
Yeah, no, I think that gets at a big point around, and this is about the business we're in versus the business you're in, right? So fund size has a real big impact on the types of investments that a fund can make. So if you're a $400 million venture capital fund, right? If you watch the news, you see everybody's raising money and they just closed, $1 billion fund. Well, so the way this works is you're trying to make investments that will return that amount, right? In other words, if you have a $200 million fund, every investment you're making, you're looking at it to say, will that give me $200 million? Because the way that the economics work in this is that the investors don't get carry, which is profit share, until that fund is returned. The people that invest in the funds aren't happy until they begin to get their money back, right? So that's an initial threshold. And so sometimes when you can have interactions, and I did this as an entrepreneur, I didn't know, and I sat down with somebody that had a really big fund, and it was a friend, and it was an odd engagement, because it was a couple $100 million fund, and what I was pitching was not going to be that. Like, it was not going to be a $500 million exit, it was plausible that it would be somewhere between 30 and 80 million bucks, right, within some time period. Like that's a good zone for us, right? We're a $6 million fund, right? But as you, and that's back to kind of knowing your target investor and the fund you're going after, right? If it's a $20 million fund, they're going to have a certain threshold of return. If it's a $6 million fund, they're going to have a certain threshold, or if it's a 200. And depending on what you're trying to build, the $200 million fund may be the better capital partner for you, right? Or it may not. So I think those are important things. So that's just an informed way. It's a way to pre-qualify a conversation. If you know what your ideal, investor profile looks like, and it's like, yeah, I'm going to build this thing, and I think there's a plausible scenario that we can get to a $50 million exit trajectory within 5 years. So let me go find people who that would be interesting to.
So we've got 3 minutes left. I think we've answered every question.
I know, yeah. Our if we have overlooked something, keep us honest here.
Let us know. And I want to just comment again on the substance of the questions. We really appreciate that. We know this is it's like, I think there's some saying about may you live in interesting times. We know that this is a very complex time for people generally, and certainly for leaders and entrepreneurs. And so, we wanted to be available to just provide insights as they're helpful. Use what you can, discard what you think is ridiculous. These are really just, kind of our opinions and stories based on our experience. And if they're helpful to you, that's great. Gives you some idea of our culture as a fund, our approach as a fund, our expectations as a fund. And we like to have entrepreneurs be aware of that so that if it's potentially a fit to come and apply to our fund. And also, you may know others that are, seeking funding that you can let know that we exist. And we'll be doing these office hours occasionally as they're useful. Let us know if you think it was helpful, or if there's something that we could do differently, because we're always sort of looking to, we're continuous improvement people, and we don't want to waste your time. So thanks, Robert. Really, really enjoyed hearing what you had to say today. It was great.
And Julia, as I did, you as well. It's always great to hear your voice. No, I think this is great. We didn't know we wanted to do these. We were going to do it if nobody showed up. So we appreciate everyone that showed up and stayed with us. The plan is to maybe do these on some type of interval. We don't want to pummel the world with our voices, but if we make ourselves available on a monthly basis. One of the questions is, will this be available as a recording? These are stuck on our, we'll eventually get up on our website, CascadeSeedFund.com. If you scroll all the way to the bottom, there's kind of a news section, and they'll be posted in there. And because we're fancy, we have a YouTube channel where we'll post it as well. It's the Cascade Seed Fund YouTube channel.
Awesome. Well, everybody have a great day and a great rest of your week ahead. And thanks for spending some time with us. We appreciate it.
Yeah, thanks all.
I'll talk to you soon, Robert.
All right. See ya.
Okay, bye.